Forget the AI revolution. If you're not investing in the green energy transition, you're missing out on one of the biggest portfolio boosters this half of the 21st century. Trillions of dollars from all over the world are being pumped into this initiative, and companies are scrambling to capitalize on this movement with massive success. Today we're taking a look at one of these companies, NextEra Energy Partners or NEP, and analyzing their financial growth and dividend distributions. This company was recommended by Jamie Botero in the comment section of our Top 5 Dividend Stocks video, which you can watch by clicking the link in the description. If there's a company you want us to analyze, leave a comment and we might feature it in a future video. Before we dive into NEP, however, we need to talk about the green energy transition and why it will be a huge driver of portfolio returns over the coming decades. The green energy transition refers to the global shift towards cleaner and more sustainable sources of energy in an effort to mitigate climate change and reduce reliance on fossil fuels. This transition has gained significant momentum in recent years, driven by a combination of government initiatives, private sector investment, and technological advancements. Governments around the world have played a crucial role in promoting the green energy transition. Many countries have implemented policies and regulations to incentivize the development and adoption of renewable energy sources. One key aspect is government investment in renewable energy projects. Governments allocate funds for research and development, as well as grants and subsidies for renewable energy infrastructure. These investments provide financial support to renewable energy businesses, enabling them to expand their operations and deploy clean energy technologies. In addition to direct investment, governments also use tax incentives to encourage businesses and individuals to adopt green energy solutions. These incentives can include tax credits, exemptions, or reductions for installing renewable energy systems or purchasing clean energy equipment. By reducing the financial burden and improving the return on investment, tax incentives stimulate market demand for green energy technologies and encourage businesses to transition towards sustainable practices. The green energy transition has created numerous business opportunities across various sectors. Renewable energy companies have experienced significant growth as they develop and operate wind, solar, hydro, and other clean energy projects. This has led to the emergence of new job markets, including the manufacturing and installation of renewable energy systems, grid integration, energy storage, and energy management services. Furthermore, the transition to green energy has spurred innovation and entrepreneurship. Startups and established businesses alike are investing in research and development to create innovative clean energy technologies and solutions. This has led to advancements in areas such as energy storage, smart grid systems, and sustainable transportation. The green energy transition also presents opportunities for collaboration and partnerships between businesses, governments, and research institutions. Public-private partnerships facilitate knowledge exchange, technology transfer, and joint investments in large-scale renewable energy projects. With trillions of dollars being pumped into this industry by governments, NGOs, and private investment, the next big energy companies will likely be those that focus on renewable energy sources. Most of the world is still reliant on fossil fuels, so renewable companies are mostly still in their infancy and provide massive opportunities for investors to get in on the ground floor. One such company is NextEra Energy Partners. NEP is a leading renewable energy company that generates revenue through various avenues, primarily by investing in renewable energy projects, including wind and solar farms, as well as natural gas pipelines and nuclear power plants. One of the primary ways NEP generates revenue is through the sale of electricity generated by its renewable energy projects. NEP owns and operates a substantial portfolio of wind and solar farms across North America. These facilities provide clean energy by harnessing wind and sunlight, which is then fed to the electrical grid. NEP enters into long-term power purchase agreements with utility companies, enabling them to sell electricity at predetermined prices over an extended period. These agreements provide NEP with a steady stream of income from the sale of renewable energy. Additionally, NEP earns revenue through the operation and maintenance services it provides to its renewable energy projects. O&M services involve the monitoring, upkeep, and repair of wind and solar farms to ensure their optimal performance. NEP has a team of experienced technicians and professionals who oversee the day-to-day operations of these projects, including regular inspections, equipment maintenance, and troubleshooting. These services generate income for NEP while also ensuring the long-term reliability and efficiency of its renewable energy assets. Furthermore, NEP benefits from the acquisition and development of new renewable energy projects. The company actively seeks opportunities to expand its portfolio by acquiring existing facilities or developing new ones. Through strategic partnerships and collaborations, NEP identifies and evaluates potential projects, conducts due diligence, and negotiates acquisition and development agreements. By adding new projects to its portfolio, NEP increases its capacity for generating electricity and diversifies its revenue streams. Now that we understand how NextEra makes money, let's dive into their dividend distributions and see if NEP is worth buying. NEP's current dividend yield is 5.7%, which is significantly higher than their 5-year average yield of about 4%. NextEra's 5-year dividend growth rate is 15.5%, and their 3-year dividend growth rate is 15.1%. indicating they have maintained their dividend growth over the past 5 years. NEP has raised their dividend every year since 2014, giving them a 9-year dividend increase streak. Not only has NEP increased their dividend year over year, but they've also increased their dividend quarter to quarter as well. It's worth noting that NEP is a limited partnership, which means that most of their dividend distributions are return of capital. This has important tax implications both in the short and long term, so make sure you understand how these dividends will be taxed before you buy. Payout ratios on net income, operating cash flow, and free cash flow spiked as high as 450% over the past 5 years, many of which also had negative net income or free cash flow numbers. Since NEP is a limited partnership, high payout ratios are to be expected to meet tax requirements, but payout ratios in the high triple digits is a little concerning. NextEra's financial growth over the past 5 years has been a little all over the place, with net income growing at 45.8%, operating income declining at 25.9%, operating cash flow growing at 17.2%, and free cash flow declining at 22.8%. If we invest $1,000 in NEP today with an initial yield of 5.73%, 15% dividend growth, and 5% share price appreciation, our yield on cost after 20 years would be 1,246%, and our average annual return would be 21.4%. Over 20 years, $36,000 worth of dividends would have been paid, and we would earn $19,500 on the 20th year. It's important to note that we left the dividend tax rate as 0 since return of capital isn't taxed as ordinary income. But in the event that you sell, these gains would be subject to either short-term or long-term capital gains tax. The green energy transition is a huge opportunity for investors to diversify into the energy sector and participate in a worldwide movement towards renewable energy. With trillions of dollars earmarked for solar, wind, and hydroelectric power generation, these companies have a huge leg up on traditional energy producers. Advancements in technology have allowed for more energy production through renewables, with the end goal being net zero emissions by 2050. There's a lot of debate as to the feasibility of this objective, but with many governments, NGOs, and companies backing the movement, there's definitely a huge financial incentive to solve the problems associated with renewable energy. NextEra Energy Partners is a leader in this fight towards decarbonization and a decreased dependence on fossil fuels. This forward-looking strategy gives NextEra a solid outlook from a macroeconomic standpoint, but I am a little concerned about their dividend distributions. The high payout ratios and erratic financial growth doesn't demonstrate the safest dividend, and their increase streak isn't long enough for me to look past the possibility of a dividend cut. That being said, if NEP continues to grow its dividend for the next couple decades and manages to bolster its financial growth, the income payoff and overall returns will be well worth the risk. NextEra presents a huge opportunity on the renewable energy front, but there are many other solid dividend-paying companies worth looking into. One stock we analyzed recently was Bank of Ozark, a business and personal banking company with a parabolic growth trajectory and massive dividend growth. To check out our analysis of this stock, click on the video card here or in the description. Thanks so much for watching. Till next time, stay safe and take it easy.